Welcome back, everyone, to Vox Markets. My name is Paul Hill, and by popular demand, I am delighted again to be able to speak to Judith MacKenzie of Downing Asset Management, one of the UK's finest mid and small cap investors. So welcome, Judith.
Good to see you again, Paul.
Yeah, happy New Year. And given this sort of like the recent investor concerns over sort of like rising bond yields, particularly sort of treasuries now, I think the 10 years at about sort of just touching 1.8, and also sort of like central bank tightening in the UK as well. What's your sort of outlook for equities in 2022?
Well, you know, Paul, we're bottom-up stock pickers, so we don't really like questions like that. But
sorry about that.
Yeah, thanks for that. Good start. But it's quite interesting. Over the last couple of weeks, we've been looking at, I'm just trying to look at some stats when it comes to UK smaller companies. And JP Morgan did quite a good report, actually, quite recently. And they were looking at 20-year average PEs for different segments of the market, and just sort of get these numbers right. So large growth has a 20-year average PE of 12.5 times. And it's on 30.6 times now, so quite interesting in its own right. Small cap growth has a 20-year average of 35 times, and that's on 43 times PE at the moment. And then you go to good old micro cap, small cap value, and that's actually sitting at a discount to its 20-year average. It's on about sort of 15 times versus over about 17, 18 times the 20-year average. So I know there's a lot of headwinds at the moment, but actually I think if we stick to our knitting, and especially with the inflationary concerns that there are at the moment, there will be more of a return to value. I know I've been saying this the last couple of years, but there will be more of a return to value. But we're very happy buying good, solid, durable earnings growth companies at that bottom end of the market with more of a value bias. So although, as I say, some of the headwinds aren't that great, we're very happy to be in the position that we are.
And how do you actually select between a sort of like a value play and a sort of like a value trap? Is that sort of like going up the quality chain, looking for pricing power? And
yeah, I think so. I mean, even more so now in this environment. I think you might, in the past, you might have been able to afford at certain times of the cycle to get into situations that are maybe slightly value trappish, as long as you had a decent stake in the ability to trade your way out of it and make the changes. I think even more so now, you're looking for that durability, the quality of earnings, the history that shows that these companies could trade through a difficult cycle. And you know, there's a lot of little niche companies within our space that actually are quite good at doing that. So you know, it really is about that quality of earnings that you're trying to buy where other people may be not looking.
Yeah, well, I was actually picking through some of your portfolio, and you've got a fantastic selection there, obviously, of value, some post-COVID winners. You've got some sort of like turnarounds and fallen angels and some exciting sort of new healthcare opportunities. But let's just kick off with some sort of like ones which are those high quality plays that I think you have held for years. Sort of Volex, your Tracsis, and a sort of a new one, EQLS. So let's perhaps kick off with Tracsis, because I mean that is just a fabulous business.
Yeah, we've held that for 10 years.
Oh, okay. Well, you've done very well then.
Yeah. I think we were buying it at first at like 45p, and you know, clearly it's I think the price target on it, our price target on it now is about 13 quid or thereabouts, maybe just north of that.
Yeah, it's just south of £10.
Yeah, it's just south of £10 now, and it's still got, I think, another decent sort of, you know, it should go to at least 13, I think, just on the basis of the current earnings forecasts that are in the market. It's not the cheapest, but the quality is really good. And we've monitored that company through when it was really just one software solution for the rail industry. And now it's a kind of multifaceted transport solution. Everything from rail right the way through to event management and passenger ticketing. So, you know, it really has evolved. It's been quite a good acquisition play as well. So you've really got to be able to try and cut out what the organic growth is and the acquisition growth. But if you look at it over the years, you've had consistent organic growth coming from those core earnings. And actually, you look back to the software that we first invested in 10 years ago, you know, that has now evolved into being 20-30% of the underlying business, and is still 70% tight margins, and it's all regulatory driven. So they're selling into the train operating companies typically for the lifetime of the franchise. So very attractive model. So yeah, okay, it doesn't look the cheapest on paper, but that quality, the regulated markets, And the visibility that you can get from the revenue stream really gives us the reassurance that it's something that you want to hold. We've had it in our IHT portfolios now, as I say, for about 10 years, and it continues to be one of the major positions in the portfolio.
Yeah, and so how do you decide? I mean, it's isn't the problem I regularly get when you get to see a 20 bagger, but sort of like, how did you decide when you sort of like first put a initial position on when it was the market cap probably in the region of about sort of, I don't know, 20 million, and now it's touching on sort of 300 million, I think. Is that 300 million? Yeah. Something like that sort. Yeah, that sort of number anyway. So how do you decide then to sort of what point to sort of take profits, or is it really just because it's such a high quality business and an asset and is putting great returns with pricing power, you just stick with it?
Yeah, there's an element of sticking with it. I think I look back actually to my initial investment committee note from 10 years ago. Clearly, it wasn't quite right, but we were looking at a price target there of about 89p when it was about 40 odd. And then, but actually what happened was, they ended up, they grew their earnings 10 times as well as growing the share price by the magnitude that it has as well. So you've got to always go back to your original investment case and then look at what's changed. And I'm always wary about changing a share price target upwards because it's dead easy to do that, especially in momentum markets and technology markets. So you really got to go back and understand why you're changing that share price, what the component parts are. Is it increase in return on invested capital? Is it because cash flow is better than you thought? So each time we're going back and readdressing it, it was because of pure fundamentals. But clearly position size becomes quite a dominant feature when it comes to those decisions as well. And what we've done is we've taken profits as we've gone. And at the same time, I'm still buying it today for some new clients coming in for IHT, because I believe there's another 30+ % upside in the share price as it stands at the moment. So, that it's really balancing the positioning in portfolios as well as looking fundamentally at what the business is doing and how it's changed. And in that time, it's had a new chairman. Its CEO has changed, which concerned me a little bit at the start, because we really backed that chief exec. Its FD has changed as well, but actually what it's done is grown up into being more of a mature, almost quasi mid-cap company. And actually, Rosalie Banyard came on board last year with us, and she runs the Downing Unique Opportunities Fund, and she's been following Tracsis as well for about 6-7 years. So, having that co-fund manager to be able to bash the ideas about, it really gives you confidence that these types of companies are things that you don't want to let go of too soon.
Yeah. Well, another one with the same sort of problem, very nice problem to have, is Volex, isn't it? Because I know we've chatted about it for about 2 years and the share price keeps going up, albeit actually it's come off a bit at the moment. It's coming back into, in fact, it's about 15 times PE going forward for quite a high growth business. What are your sort of view on Volex?
Yeah, so the results that came out prior to Christmas, about 2 or 3 weeks before Christmas, were pretty much bang on our expectations and bang on numbers that were in the market as well. I think there was a couple of dynamics that have made the share price come back. And one is that it attracted a lot of interest from new shareholders, probably over the course of the last sort of 8-9 months or so. And that's when you saw that share price really appreciating. I think it went from about £2.50 to close to £5 over a relatively short period of time, because people were beginning to realise that if you look elsewhere in the market at some of the other peer groups, then they're on 28 to 30 times. So there was quite a bit of profit taking after the results came out. And I think they were quite confident about their statement when it came to supply chain. And I don't know if you remember that period in the run up to Christmas. Everybody quite rightly was paying so much attention to whatever was being said about supply chain, and they were relatively neutral on it. And I think they can be neutral on their supply chain issues that they tend to mitigate because they are such a global business now. And when we invested first about 4.5-5 years ago at 45p again, actually, then it was a business that was focused on maybe 1 or 2 verticals. Now you've got healthcare, you've got good old EV, you've got data centers.
Good old EV. I mean, that's sort of like a £3 trillion business potentially, isn't it?
I know. And that's when we look at sectors, we're not really looking to jump from old economy into healthcare or to EV or whatever. We're trying to do it kind of covertly, a bit like we are with Volex, where 4 years ago it didn't really have any EV exposure, but now it's got access to that through pretty much their old business that's migrated into this newer part of their business. So that's quite a nice way to do it, because you're not having to pay the price that a pure EV price tag might have. And at the same time, as you say, it's on 15 times earnings at the moment. Pure group's on 30 odd times. So there's a lot here. We're still, this is still one of our major positions in our portfolios, despite it having come back. I think there's going to be, they're buying businesses at 6 to 7 times earnings, so half the price that they're on, and their peer groups on double that, and you're still going to get 10% type margins coming through as well. And there's a few little self-help measures that we've got too. So yeah, I think we're pretty happy with it where it is.
Well, it's got data centers back in it as well, hasn't it? Sort of like, that's another big, huge driver. I mean, that isn't going away, is it, because of the pandemic?
No, absolutely not. No,
and one which is moving to another one, which is sort of like it's a bit earlier in the gestation. I don't think you've held it for sort of 10 years. Is Equals a sort of like a Forex international e-payments type of company that's gone through the mill sort of 2 years ago, but it seems to have now come out and has still got plenty of sort of like potential sort of key drivers going forward, not least its B2B payments business, and hopefully sort of like international travel related Forex payments this year, well, to 2022.
Yeah, it's a nice wee business. And it's one, as you say, we're getting to know. We invested in it probably about in the last 6 or 7 months, so we're learning as we go. But what I really like about this management team is that they're really transparent. They put out their transactions on a quarterly basis, so you can do your own numbers on it. You don't really need to rely on a analyst forecast. And they've got a run rate of about $1 million a month at the moment, and so that would equate to, just say it might be revenue of say 50 million in 2022. And then that's,
it's $1 million. I think it's $1 million a week. Actually. It's $1 million a week.
Is that a week?
A week.
Oh, right. So it's easily going to make 50 million worth of revenue, isn't it? And then you translate that through the operational gearing that you can get, in this business is such that that equates to about 8 to 9 million EBITDA, and on 122 million worth of market cap. So I think on my prudent numbers, there's at least 80% upside to where we are on a share price of what's about 66, 68 or thereabout at the moment. So we're learning more about it, but I really like the way that they've adapted the business in such a way that they really are stealing the lunch out of some of the big boys, the big banks' pockets. And that's been proven now on your quarterly numbers that are coming through. And the other dynamic that's quite interesting, one that we got a little bit scared about to start with, is the whole Crystal Amber situation. And clearly they've got
they're the biggest shareholder, aren't they? About 20% or something.
Yeah. So you've got to wonder what their agenda is. Crystal Amber themselves, that fund, as they're now going into defined runoff over the next 2 years. And when you look at their statements, they're quite clearly saying that there's a pocket of their investments that they think are going to be subject to corporate activity. So, and they've got a man on the board, I think, as well. So yeah, I think there's quite a few interesting dynamics here, but fundamentally it's a really nice growth stock that you're buying at, I think, quite a cheap price.
Yeah, it's a platform, isn't it, basically? Yeah. And now moving on to some sort of like fallen angels and turnarounds. Let's start off with a company that put out a business update actually this morning, Venture Life, which is an OTC healthcare consumer brands business. It owns and Dental, I think, and Ultratech, Dex, and other sort of like niche brands, etc. And I know we've chatted about it a couple of times. You've held it for some time, and it went through the ringer towards the back end of last year. Has got impacted by some of the COVID-related supply chain issues, higher freight costs, input costs, and also seen a sort of slowdown through its distribution. But the news this morning, I think, as I read it, was that it's actually swapped out its Chinese distributors. Do you want to give us an update on this one? Because it does look extremely cheap on about 8 times EBITDA, with the sector at about 15 to 20.
Yeah, you've got to trust the numbers. And I think that's where I'm maybe going to be slightly cynical to watch what I say, but you've got revised forecasts. I think it'll be EBIT down about 5 million for this year, and then about 8 million going forward as well.
Yeah, I think it's 8 million in 2022.
Yeah, 2022 numbers. So, and so we will have the December numbers around about March, April time, and those are revised numbers. So you'd like to think you'd have confidence in them. I think my cynicism is about, if you just look at the headlines, if you look back, and this is with the benefit of hindsight, isn't it? So they did a war chest fundraise in, October, November 2020. Yeah, thereabouts. Yeah. And then it took much longer than I think people expected to get the BBI deal done. And BBI is an okay business. It's a good business. It's not massively high quality, but it's probably going to be better quality when it's combined with Venture Life and the capacity that they've got there. And there was costs obviously to be taken out as well. But where my slight cynicism is, and I think it's going to go in the right direction, is that some of the, I'm going to say excuses, and that might be a little bit unfair, but some of the excuses used around COVID, the Chinese distributor, supply chain issues, I think some of them were self-inflicted. Right. They were self-inflicted through a degree of indigestion, and this is my view, but an entrepreneurial management team that were then having to manage quite a big acquisition. So what do you do about that? Bearing in mind that management sold out at the time of the placing at 95p, and okay, they're buying, I think they bought in 30 grand each a couple of weeks ago. But you've got the dynamics here where I think there needs to be some more checks and balances and controls. Fundamentally a good business, but to buy in at the moment, you've got to be able to trust those numbers, those readdressed numbers. And I think with a new chairwoman coming on board over the course of the next few months, could there be a risk of a bit of kitchen sinking, a bit of tidying up the shop? I actually, to a certain extent, I really hope they get in control of some of the checks and balances that need to be put in place. And then I think you're going to have a cracking business that can really deliver on numbers in a continual way. So I think it's interesting at the moment. I would just be slightly wary on the quality of those numbers that are in the market. I could be being very cynical because I've had my fingers burnt by it a little bit. But it's a good business. It's a really nice business.
Well, I mean, one of the real sort of like benefits of putting your money in Downing's funds is they are active investors, aren't you? I mean, you basically make sure you hold the feet to the fire, sort of like the management teams, and presumably this is another one whereby you're going to be quite influencing the board or trying to. I don't know. I'm not sure exactly what your stake is, etc. But you'll be pretty vocal about sort of like how you see the longevity and what needs to be done, I guess.
I think they'd probably understand our views. I don't think there's any...
Well, that's good to know, exactly. And then another one, which was sort of like just moving on, Norman Broadbent, which is really the sort of the micro type of stock. It's about a 4 million sort of like market cap business, etc. And I remember it used to be a premium executive recruiter in the UK. It had some very swish offices down in London that I've actually been to once anywhere in my life. And I was impressed, but I didn't realize just the scale of the business. And can you talk about that one? Because it's obviously if you look at the share price, it's come off a lot over the last 5 years, but it's bumping at about 6.5p. And what do you see there?
Yeah, this one does look a little bit left field. And in turnaround situations, I think ideally you catch them at the time where it's just, you can start seeing cash flow coming through and you see a change in sentiment in the numbers, not the narrative, but the actual numbers. And this was quite interesting because just at the tail end or middle of last year, we changed out some of the management here, and a new exec chair went in place, a chap called Peter Searle. And if you look at Peter Searle's CV, he was in Spring Group PLC, Adeco, and he sold one of his businesses to Adeco in the past. He was in AirSwift, and I think originally he was the computer people. So he's done a lot of M&A in this sector. He's also come in and he's bought 6% of this business as well. So you've got to think that something might be going on here. And then you look at sort of recent statements and you see a return to a break-even position. And also there's been an awful lot of M&A going on in the sector. And I think, you see wage inflation coming through this year as well. I think it's going to be, especially in IT and some subsectors, you can see that there's going to be probably quite a buoyant macro environment for them. So, and we've just taken on a new chief exec as well. So, and he's got great experience in the renewable space. So I think it's probably going to be one of those ones to keep an eye on. It's not one that everybody would jump into at the moment, but if you look at the incentives that the management team have got, that's to get EBITDA to well north of about 1.5 million before they really get anything. And I think there'll be opportunities to find acquisitions and ultimately exit. So we see this as a kind of 2 to 3 year game plan. It doesn't hang around for long.
Oh, okay. I mean, one thing that I've sort of like, for my cost and pain, come to realize is that if you want a successful turnaround, one, you obviously need the right sort of business and industry and blah, 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 and a bit of luck as well to a certain extent. You can't control absolutely everything. But you really need one ingredient is hunger in the management team. And it might have be people who have been brought in and done it before, but they may not have the hunger. Have these guys got the hunger? Are they really sort of up for the challenge to be able to? Because, I mean, it's quite a major job. It's 24/7. We all know this type of stuff.
Yeah. Yeah, I think on Norman Broadbent, they've got a good core team. So their net fee earners are really good. They've just got to be incentivized in the right way to get that hunger. Peter, yeah, I mean, he's a deal doer through and through. And Kevin is, who's the new chief exec, he is, I probably shouldn't be ageist about this, but, you know, he's young enough to still really want to drive something. And he's, you know, the incentive structure that has been put in place incentivizes the whole team. I think one of the difficult things in recruitment is that your assets walk out the door every night. So you really need to be able to tie in your people. And you've got to create the culture that they want to be there. And you've also got to make sure that the financial incentives are there. And I think we've put the right groundwork in place. As I say, not one for everyone at the moment, but it's going to be, it's worth, in turnaround situations, it's worth just monitoring things over the, you know, a course of a year or so. And you can then try and figure out the right time to jump into it.
Well, you have a pretty good record at identifying these sort of micro stocks and doing. We'll come on to another one with Digibox as being one in a moment. But FireAngel, that seems to have been a sort of like it's in a nice industry, regulatory. It sort of does sort of like connected or smart, sort of like you know, fire alarms and carbon monoxide alarms in houses and all this sort of stuff. So it's absolutely in the right space. But it keeps sort of like falling over it. It hasn't yet sort of like really hit that sort of hockey stick moment.
Yeah, I think that's where. So they were brilliant at finding. Sounds a bit ironic, but they were brilliant at finding banana skins through the years. And you know, it was
that's like my portfolio.
Yeah, I mean, it was painful because, as you say, they're in the right markets. They're regulated markets, and you know, there's really only 3 or 4 main players, especially now. So, you know, what did we want to do with it? So about, gosh, I'm trying to think now, it must be about 2.5, 3 years ago, we brought in John Connolly as exec chair, and he had quite a lot of self-help to do in terms of changing the business operationally, but also if you think about what's been happening over the last 2 or 3 years in that whole fire and security space. You know, you used to go into B&Q and buy a smoke alarm with batteries in it, and probably they were getting about 10-20% margin, probably less than that actually, about 10% margins from that type of product. But now regulations come in, and we know about it in Scotland because by the end of February, every house has got to have Wi-Fi connected alarms on every floor. So, you know, that's for each house, that's probably spend of about 120, 150 quid, if not more than that. And these products are at 40 to 45% margins. So what we saw was that there was this migration away from that really low margin, almost commodity type product to something that was far smarter. And then you layer on top some of the horrible things that happened at Grenfell, then you can't, from a housing association point of view, the regulations coming in, where again, it's all going to be about connected home, getting back to the local fire station and being far smarter. And good old FireAngel, you know, they've been investing quite heavily over the years, and they're now in a really good place to be able to capitalize on that. But what we had to do was to get that operational structure far cleaner, far more efficient. And what you're seeing now is that the margins have gone up from about sort of 16, 17%. They're now at 22 to 24%. Without COVID, they would have been about 26 to 28%. And we're really just at the start of that journey into that.
That's gross margins, is it?
Yeah.
Yeah.
So, and then you've got, you know, the whole the corporate structure's changed quite a bit as well. There's been quite a bit of cost taken out of that. So it's about 1.5 million of cost taken out. So over the course of the next, well, really this year, you'd expect it to be a 50 million turnover business with roughly about 4.2 million of EBITDA in 2022. And then moving to 2023, it's going to be north of 7 million EBITDA. And I completely understand in these situations where they have been turnarounds and you've not yet seen the true evidence of that cash generation coming through, you really just want to keep watching from the sidelines. But I think over the course of the next sort of 6 to 12 months, this could be a really interesting play, because you will see that cash generation coming through. You will see the margins improving, and then it becomes, and it'll be on a double-digit free cash flow yield as well. But you know, at the moment, I can see that because we're a 18% shareholder and we're close to it. But for the outside viewer, I can understand why people will be sitting back and just waiting to see what happens. But yeah, we're pretty confident about it. It's a good team.
And shouldn't I mean, this business, to me, from an outside perspective, should ideally be part of a bigger group, a big industrial, maybe a smart home type of bigger smart home business that could just wrap it in as another product set and sell it into the same sort of like through the same channels. I mean, there must be a lot of intrinsic synergistic value of combining, obviously, the FireAngel brand and business with a much larger business, whoever wants to take it.
Yeah, yeah. I mean, one of their big shareholders is a large American distributor.
Right. Okay. Okay.
So you don't want it taken out too early, really.
No, I know. Yeah. Yeah, but certainly smart home type businesses go for really strong premiums, multiples of sales, never mind EBITDA.
Absolutely.
Yeah. Now, to move into some sort of like post-COVID, some winners, as I say, you've sort of like picked some fab companies we've talked to about. Let's start off with Digitalbox, and they came out with a brilliant post-Christmas trading update, I think a couple of weeks ago or last week, saying that they're expecting better than consensus expectations. Do you want to take us through that one?
Yeah, so again, Digitalbox was really quite small when we first invested in it.
It was minute.
Yeah, it was. And you know, it punches above its weight.
Yeah.
They so they're a publisher, online programmatic, I never say it proper, programmatic publisher. So they've got Entertainment Daily, which appeals partly to middle-aged women like myself. Then they've got the Daily Mash, which is a satire type magazine online, and we just got involved when they were buying another asset called The Tab, which is the UK's largest online market magazine for students. So what they've got is some great little titles, albeit individual titles at the moment, and they've got an algorithm, they've got a platform where they basically plug in these titles, and they get some of the best sort of push through in terms of advertising rates and being able to monetize exactly what the content is on these sites. So they've got some good unique content which drives people to the site. They then get the advertorials coming through, and then they get the revenue stream coming from that. You get it right, it's a 70% margin type business. They did bounce around through COVID, and the thing is, you know, you can look at this business and you can forecast it you can get live information, but it's quite difficult to forecast on a annualized basis. And what we had was a really, really good outcome from Entertainment Daily in particular at the tail end of the year, and it really has skewed the numbers. So, you know, this is going to be it's a 1 million EBITDA business plus, and at really decent margins. So, and there's also the key for us here now is further M&A activity, because the Tab, I think, will probably have paid itself back within a year of acquiring it. So that's not a bad kind of turnaround for a business that you bought. And I think there are some latent assets, latent titles that are sitting there a little bit unloved. And with this machine, this platform that we've got, then you can really see it going from strength to strength. So yeah, we're hoping that there will be some further M&A activity in the coming 12 months. And it's a good team. They've now proving that they can do both the organic growth and the acquisition side as well.
Yeah, what I hadn't appreciated when you first sort of highlighted it to me and to other people is the importance of the first party data, because obviously you've seen the cookie tracking disappear from Apple, and it's also going to go from Android phones at a certain point, which means that if you've got your own proprietary internet real estate, which these guys have got, you effectively control the entry door for advertisers into this customer base. And I've seen this movie before, and when you mentioned M&A activity, I would not be surprised if you get CEO, similarly, somebody such as CEO Zilla from Future Group knocking on the door, because there'll be huge synergistic value for bolting on a business like this into any other type of larger publishing company that can really internationalize these assets, I guess.
Yeah. I mean, the chairman that's come in the last 6 months or so, Marcus, he sold his business to Future. So
Oh, really? Oh, okay.
Yeah, it's a very incestuous industry, as you can.
I'm not surprised. Yeah, the synergies are huge. Another one which is in that type of area is Centaur Media. They again put out, I think it was pre-Christmas, put out a better than expected trading update, and I think is it Swag Mukherjee who looks after it, the CEO?
Yeah, Swag, yeah, absolutely. I mean, again, you know what's nice about this one, I think you've got a degree of optionality here as well. So you've got what we would regard as the sum of the parts valuation, because the lawyer, which is the main title that we got there, is subscription based. So you've got really good long-term revenue aspirations, and then you've got the marketing side of the business as well. Some of it is event driven, and they don't really sit naturally together. And therefore, you can look at the valuation of each part of the business. And I think probably the lawyer is worth pretty much the market cap of the company at the moment. And so you're getting the marketing side actually thrown in for free. And the marketing side of the business obviously bounced around through COVID, but so you've got a bit of COVID recovery coming there. And at the same time, you've got the growth that's coming. They run a program called the Mini MBA, and that the growth there has been exponential through COVID. And that's really not quite reflected in the numbers yet in forecasts. And here you've got quite a strategic shareholder list. So Gresham were involved, but now that stake's moved to Harwood, and Harwood's also got a stake. So, you know, guess what? I think, in fact, I think it was Mr. Rose on one of.
Yes, he was. Yeah, he was talking very positively about it.
He might have mentioned it, and I think he said something along the lines of, you know, something's going to happen with this company. If it doesn't, then I'm going to make sure it does. Something along those lines. So we kind of feel the same way about it. Swag comes from private equity, he's got a private equity background, so it's not going to be sitting here forever just doing the same thing. And I think next year it's going to have a double digit, it's going more than that actually. Yeah, it's high double digit free cash flow yield. So it's they've got this thing called MAP 23. So in year 23, their margins are going to be at 23%, and they're well on their way to that. So they're good at under promising and over delivering. Always get that the wrong way around.
Yeah, no, I would definitely point investors to to both of those, to Digibox and to Centaur Media, because as you say, the shares have moved a bit, but post-COVID winners, and there's still plenty of juice in the tank. And likewise, with I think the similar sort of thing with equals, as you mentioned, it's got 80% upside as well. So there's some really good. Now, just on another one, which is a Flowtech Fluidpower, which does sort of like specialist pneumatic and hydraulic parts for industry. And I know it's sort of seen demand come back as workers and factories and stuff like that have come back. But again, has been impacted, I think, really short term by the supply chain issues, just getting the product that they can then effectively give their value added services on top through the UK.
Yeah. It had a really tough time through COVID. And if you remember rightly as well, so this was a business that I suppose it was a turnaround maybe about 3 years ago, when Roger McDowell went in as chairman. And what their plan was there was to get margins up to the kind of 12% level. So, and they were very good at highlighting how they were going to do it. Then, of course, COVID hit and everything else went to whatever. And so there was about 5 million of operating cost savings, which are largely delivered, but there's still more to come through. And they've delivered about 5 million worth of working cap benefit So you've still got some of the operational efficiencies still to kick through into that margin. And pre-COVID, they were doing about 112 million of turnover. And so even just say they get back to pre-COVID levels, which I think they can exceed on because they're doing a lot online, and you put a 12% margin on it, then it looks really quite cheap. I think you've got, I'm not wanting to put a price target on it, but I think you've got close to double your money on it if you take a 2 to 3 year view. And you've got Roger McDowell, you've now got, as you say, got a shareholder list as well that is
Christopher Bills.
Yeah. Once again, an Odyssean. So you've got people that are certainly holding this management team's feet to the fire and certainly feeling a lot of benefit from that lockdowns unlocking, thank goodness at last. So yeah, a good benefit coming through there. I think we'll see that coming through over the next 6 months.
And what about sort of Ramsdens? I know you've mentioned this one. Obviously, they suffered because of the shops were closed or the pawnbroker shops were closed during lockdown, and obviously they do a lot of Forex as well to travellers internationally, so they should see that benefit. How do you see that one sort of playing out?
Yeah, so the loan book should further recover in 2022. What they've been really good at through COVID is their, believe it or not, their jewellery sales. So they moved quite a lot online, and that's actually been quite a buoyant market for them. So, which is pretty good. And the jewellery segment is actually above where they were before COVID, which is kind of ironic. So you've got the stores reopening, you've got FX coming back online, you've got the loan book improving. So it really is. I think this time last year we probably said that 2021 was going to be its year. I think 2022 is going to be its year. There is a bit of a question mark over people moving from buying currency onto prepaid cards, because we're all now so used to using cards as opposed to cash. The demographic that this company serves tends to always want to use an element of FX. And what we're reassured about is that they're coming out with a prepaid card, really just at the start of this year. So we'll be able to capture some of that market now as well as the FX market returns. So I think, you look at sectors that I think will rebound quite nicely in 2022, then travel and tourism has got to be one of them. And I think, they've got 13 million worth of cash in their balance sheet. This is not a company that's at risk in any way at all. And they've been really, really good at rolling out stores in the past. So it would be just nice to give them a chance to get back to some kind of normality because it was cheap. It really is quite cheap in terms of historic numbers, and we see those coming back.
Yeah, and I think if the sort of the consumers has to tighten its belt a bit going forward, then pawnbroking should only become more popular. But if they want to sort of like a cheap Forex card for consumers, then they should white label from Equals.
well, do it. You know it. Yeah. There's a relationship there.
Oh, really? Oh, okay, good. Then moving now finally to some sort of like exciting sort of like, healthcare opportunities. We've got recently listed GENincode. We've got, and then we've got ones which have IPO'd over the last 12 months are Arecor Therapeutics, Trellus Health, and Destiny Pharma, which is obviously, just broadly, how do you go about sort of like assessing the efficacy of sort of early stage healthcare companies, and likewise in terms of balancing that risk, sort of like, because some of them are going to work and some of them are not.
Well, I'd love to say I'm a specialist here, but
okay.
So we always say that we only invest in things that we can understand within 5 minutes, and to be honest, with some of these companies, there's no way I'll be able to understand them in 50 minutes, never mind 5 minutes. But I'll let you into a secret. We've got a healthcare team, a really strong healthcare team on our unquoted side. So we work quite hand in glove with them. When we've seen deals coming across our desk, we literally we'll have a conversation with them. We'll try, they're scientists, they're doctors in their own right. And more importantly, it's important that they're doctors, but more importantly, they've got a great network when it comes to doing referencing on IP. And actually, GENincode and Arecor were portfolio companies in their private portfolios. So we actually, as a quoted team, sat alongside our unquoted colleagues as they invested on those two companies way before they ever even thought about coming to the market. And that gives me confidence that, number one, that our guys are really on top of these two companies, and when they came to market, we knew what we were investing in. So it really is leveraging on their experience, and they're very much into looking at personalization of healthcare. So not really looking at big microbiology type solutions, really trying to get it right down to the patient, and that's what both these companies do.
Yeah, I think GENiCode, they came out with a statement today, didn't they? And I think their lead test, which is looking for sort of ultimately FDA approval, does predictive cardiovascular tests that are based on DNA, isn't it? So it's very, very personalized.
Yeah, and that's where healthcare is going, and so therefore we're not really looking at any what would regard as old sort of healthcare type solutions, but it really needs to be quite personalized. One exception there, so Destiny was also known by Matt and Will in our healthcare team. I think at one stage Will again had invested in it in a previous life. So it's great to have that heritage going back in public companies where this team knew them privately. But Trellus is one that I was keen to back, and I don't know if you know, but that was a spin out from another one of our businesses called EQLS Diagnostics, where we're also a shareholder. And it was we had the privilege, therefore, having a bit of an early look on this one. And I would say it's not so much, it is in the healthcare space, but it's actually more of a kind of software type business. So
telemedicine.
Yeah. They're trying to find solutions for, the first one is irritable bowel syndrome in the States. And what they're proving is that they can cut the healthcare cost by about 80 to 90%. So that's quite material. It's quite early stage. They're working alongside Sinai and 2 or 3 large insurance companies in the States. But again, it was one where we saw the team going in place pre-IPO. We weren't just investing in it at the IPO stage, and we've been able to track it as well. So it's a slightly, we wouldn't go in blind to a healthcare or a sophisticated IP of any sort. We need to have the expertise that's sitting there within our healthcare team.
Yeah, I think Trellus is inflammatory bowel. It's Crohn's and colitis, isn't it? And it's sort of resilience management. And I'm with you. I've spoken to the CEO, and the shares have come down. And if they can get that one to work, and let's be clear about it, Mount Sinai, they discovered Crohn's originally, so they should know all things to do with inflammatory bowel disease. What about Arecor Therapeutics, which I understand does sort of like software and technology that helps improve the formulations of sort of drugs, and they've got sort of a couple of lead candidates to do sort of like ultra rapid and ultra concentrated insulin that again could be a bit sort of game changing, I guess.
Yeah, and you saw that in the share price after.
Yeah, it's done really well, hasn't it?
Yeah, and this for us is a long-term game plan as opposed to taking profit. We're locked in anyway in some of our older stock, but we see that the news flow on this one is going to be quite good over the next 12 months. But boy, the share price, I think, over that period post IPO was a lot of retail trade. So it was really, really thin volume. So I'm not saying that the share prices maybe run ahead of itself and a little bit artificial, but it is very, very thin trade. We're going to back this for the long term, and we think that the news flow will certainly justify where the share price is at the moment.
And then just finally, are there any sort of like major sort of risks or things where investors should look out for? Just on, I know you're not a macro investor, etc. You do sort of a bottom up and stuff, but things that people should watch at all, or is it really sort of like just make sure you keep a close eye on each company?
Yeah, I mean, it's an interesting time, isn't it? I mean, I wouldn't even mention the obvious stuff like supply chain issues, inflation, whatever. These are the things that we all know about. I think there's probably some geopolitical risks that are going to come from left field. I mean, the thing is, risks are always not the ones that you know about, it's the stuff that gives you a surprise. And I think the dynamics at the moment where you've got the Russian situation, you've got Korea, China, you've got the usual shenanigans with the US. I just think I've got a feeling that there are probably more geopolitical risks at the moment than we've seen for quite some time across various continents as well, and that makes me feel a little bit uncomfortable. So therefore, I would stay away from anything that's got really thin margins because of that. Because I think some of the supply chain issues it's great that we're seeing that they're unwinding when we're speaking to our companies at the moment, we're seeing them unwinding at an individual basis. But at the same time, I think some of those could come back and bite us a little bit in terms of geopolitical risks as well. And yeah, we're just going to have to live with the background of inflation and some of it, and good old COVID, who knows, hopefully we actually, our boosters are going to let us get out there and there'll be a degree of herd immunity. So, those are just things now that we live with on a day-to-day basis. But yeah, the geopolitical side, I think, is something that is beginning to keep me awake at night.
Yeah. I think, though, if you're going to be in fixed income as an alternative to equities, you're going to get totally hammered exactly. as inflation and central banks continue to tighten. Well, thanks very much, Judith, for excellent insights and comments again. Just in case anybody wants to invest in the Downing funds, where's the best place to go? To contact you or go to the website? Or
yeah, look, I'm always very happy to speak to investors and have a debate about some of our portfolio. So my email address is judith@downing.co.uk, and our website is www.downing.co.uk, and you can get straight to the fund management side of the business through that website.
Okay, good. And I would point investors to have a look through that the Downing portfolio, because they've got some fantastic opportunities in that business. So thanks again, Judith, and look forward in touching base in about 6 months' time.
Brilliant. See you soon.
Bye.